Good evening, everybody, and this is Brijesh Dalmia from Masterstroke. Today is 9th of July, 2022 and 6 o'clock Saturday evening, and thank you so much, all of you, for joining this. Um, as usual, we have brought to you today a very interesting session, which I think I learned 15 years ago in this industry, the performance cycle. And we have none other than Akhil Chaturvedi, Chief Business Officer of Motilal AMC. And we will ask him some tough questions, believe me, guys, on your behalf. And he's all set to answer all those questions, to break some of the myths, and also to suggest about the performance cycles in mutual funds. To set that tone, welcome, Akhil, first of all.
Thank you, Brajesh. Thank you so much. And good evening to everyone, and welcome everyone. Thank you so much for logging in.
So let me start the context here. You see, different stocks perform differently, and different mutual fund schemes perform differently at different time, as well as the same time period. I will give you an example in the stock market. If you bought ITC 5 years ago, you are still there. You have not made any money in ITC even in 5 years. But if you bought ITC 3 months ago or 4 months ago, probably you have made 40% return on that stock in 3 months' time. When you see Reliance, you never made any money for 5-7 good years, and then all of a sudden the stock doubles. So we have seen this cycle in the stocks. Today, what we will try to evaluate is the story same for mutual fund schemes, and Akhil is the best person to answer this question. So, Akhil, my first question to you is this: can you briefly explain what do you mean by buy right and sit tight, and for how long?
Yeah, thank you, Brajesh. Yes, I think this is a very, very interesting session, and this is very, very close to all of us at Motilal Oswal AMC, because we ourselves have been going through a performance cycle. And whenever people like us in manufacturing AMCs, we will go through cycles. That is the time we introspect and we try to understand why we go through the cycles. We try to learn from the history and then try to put that into practice for a better future. So that's what we've been doing for the last 2-3 years since the time we went into the cycle. And I think you started on 2 or 3 very good examples. So like you spoke about 2 or 3 stocks, right? So whether it is Reliance Industries or whether it is ITC or whether it is Tata Motors, eventually all of these are great companies. They are good companies. Great companies and good companies also go through cycles. They may have couple of quarters bad, couple of years may be bad, but as long as inherent moats are very, very strong, at some point of time they become attractive bets to buy and then hold on. Essentially, buying right, sit tight is a philosophy. It actually was coined by Warren Buffett and not by Motilal Oswal AMC. We have just picked it up. We take a lot of inspiration from him. So what we mean by buying right and sitting tight is basically as long as you have bought the right set of companies, right? The companies which you are owning demonstrate very strong quality orientation, good businesses run by good managements, good promoters, companies which are demonstrating good growth potential, growth trends, and the valuations are cheap to reasonably priced. If you have a bunch of these companies, now irrespective whether their share prices are in the momentum or not in the momentum, you need to sit tight. Actually, this sitting tight, buying right is still, I would say, far more easy job, but sitting tight is the difficult part. And sitting tight is when these companies or these mutual funds, when they go through a performance cycle, you wait it out. That patience which is needed is the sitting tight part. But sitting tight happens only, yeah.
How long?
There's no definition of how long. Typically it could be 1 year, it could be 2 years, it could be 3 years. And just when you're about to give in, that nothing is going to happen and you exit out, and then you get to know that that year itself it becomes a star performer, right? So buying right, sitting tight, you can explain in 3-4 ways. One is that like Ramdevji says that long term is till such time you make your desired returns. So when you invest and your desired return is, let's say, 20%, the day you make 20%, you have an option to book your profits and move out. The other way to look at buying right, sitting tight, is become very, very long-term investors, like some of the successful investors globally and locally, including Ramdev Agarwal, is you simply buy forever. You are an equity investor, your allocation is full. You go through multiple sets of cycle, and then over 10, 15, 20, 30 years, you see that you make an average of 15 to 20%, which is doubling your money every 5 years. So just stay through the cycles, and over a period of time, you'll have enough cushion to protect you from these temporary corrections, right? So that is another way of looking at buying right and sitting tight. Third is more fundamental answer, where managers like us, we are here to obviously demonstrate returns more consistently rather than in phases. In doing that, obviously, we need to be little conscious on valuations. I think valuations in Gujarati, what we say is that bhav bhagwan hai, right? So that bhav bhagwan hai ki qadar karna bahut zaruri hota hai. So, when you buy some companies, the companies go up, become expensive, then at least active managers need to at some point of time, trim their winners, book the profits, and try and protect the IRR, right? So all these are some of the variables of understanding buying right and sitting tight. So as a concept, as long as you have bought right, sitting tight will not harm you. Yes, in phases, it may give you pain, it may give you trouble, it may test your patience, and markets do test your patience. Eventually, we are also buying stocks. Like you are buying stocks, fund managers are also buying stocks basis the fundamentals of the company. No fund manager can actually predict that when these companies' prices will go up, right? So it is a matter of luck that some years some managers will become top quartile and some years some other managers will become top quartile, right? So, and we have seen that in the last 20 years. Eventually, I think now our industry has a very sound track record of 25, 30 years. And if you see some of the old funds with NAVs of 1,000, 2,000, 3,000, and those funds are not in the top quartile today, all those funds have created immense wealth for investors. The irony is that nobody has enjoyed that. I don't think any investor is there who's put at 10 rupee and today looking at a 3,000 NAV, right? So in between, when the funds did not do, we exited, we entered. That is basically putting brake to your journey of compounding, right?
I fully agree. So, yeah. So I was thinking that, mutual fund distributors, investors, as well as mutual fund distributors chase 1-year trailing return performance on various mutual fund research sites. Even the sales guys of AMCs promote the last 1-year performance. How good and bad this is, and what is your suggestions into this?
Honestly, I spent 22 years in this industry. I'll give you a couple of my own examples, and then I'll put up 1 or 2 slides to demonstrate what I'm trying to say, right? I started investing 21 years back. I started working in 2000, early Jan 2000, right? So a nice starting point. I joined this company called Birla Global Finance Limited, and my first paycheck came $10,000. And I had a friend in a bank. She got me to invest into Alliance New Millennium Fund in 2000. And that point of time, IT boom was going on. All IT stocks were going through the roof. And I bought that fund. It was an NFO, I believe. And it was at a 10 rupee NAV. Little did I know that I bought at the peak of the IT boom. And within, I think, couple of months, the NAV came down to 2 rupees. And I actually booked my loss at 2 rupees. The 10,000 became 2,000, 80% loss, right? I'll give you another example where, without naming funds, there was a fund which is today's great performer, very, very popular, and became very, very large in the last 3 years. This particular AMC best performing fund today, I was buying and accumulating through 15 to 18, right? SIP, and it was continuously dragged for 3-4 years. It was just not moving up. And our own funds, our Flexi Cap fund, was going all through the roof. So right at the bottom of the fund cycle, I sold out everything in that fund. And I bought Flexi Cap fund, F35 popularly known as, right? I sold that fund at the bottom and I bought Flexi Cap fund at the top. And the next 3 years, like you would expect, Flexi Cap fund went down the drain, and that fund became the number one consistently for 3-4 years, right? Now those rankings are coming down, right? So third example, I needed some cash in 2020. 80% of my investments are Motilal, so I was compelled to sell, and I'm completely equity. So irrespective whether times are good or bad, I have to sell equity and get out. Good time, bad time. 2020, I needed some cash. At that point of time, our mid cap 30 fund was the worst performing fund, right? And Flexi was doing better than mid cap 30. So I thought, let me sell the worst performing fund and let me keep the Flexi Cap fund. Again, I made the mistake. Mid cap became the top quartile fund. Flexi went further down. Right. So
I like your honesty, Akhil. Honestly,
I'm telling you, I'm sharing this. You are also experiencing the same thing, and 300 people on this panel, or some point of time, would have experienced similar behavior. This is This is not that I'm wrong, you are wrong, or the audience out here is wrong, or investors are wrong. This is classic human behavior, right? We are
Before you
all
proceed, we proceed, Akhil, I want the audience, the participant, the mutual fund distributors to know this. We will handle the performance issue in two parts. One, how we as mutual fund distributor understand the performance cycle and how we explain to the client. They're two different things. If we are convinced about the performance cycle or what we are buying and what we are selling, it is easier for us to convince the investor. So it is, and this talk with Akhil is to make us understand uh, our understanding of performance cycle and how we need to behave into various different market cycles. Please continue, Akhil.
Yeah, so I think typically we all are victims of greed and fear. I think that is one behavior which most investors in stock markets, actually any other asset class, we are all victims of greed and fear, right? So when things are looking very good, we all become very greedy, and when things are very good, typically your 1 year, 2 year, 3 year looks very, very good, and we get excited and we start to extrapolate this into the next 1 to 3 years, and we buy into it, right? And then when that doesn't pan out the way we thought, we get fed up and then we sell it, right? So the whole concept about investing is, whether it is equity or debt market, also this applies, is basically taking counter cyclical bets, right? So buying low and selling high is a classic principle of making money in equities, because when you're buying low, the margin of safety is very high. Some company which is intrinsic value is 100 rupees, for some reason available at 70 rupees, the 30 rupees is basically the margin of safety what you get, right? And then when the markets normalize and the company does well, then you get the advantage of the re-rating, right? So typically when we try to chase the best performing funds or best performing stocks of last 1 year, 2 year, and 3 year, then typically you are buying tops of those funds, but obvious those funds are doing well because their underlying stocks are doing well. And kudos to those managers who are experiencing this cycle, who have got those winners, because of which these funds become Q1 funds, and they sustain for a couple of quarters before they start to lose their quartile rankings. So we chase the winners, we chase the past performance, and we enter, and then within few quarters or few years you realize that eventually the fund quartile rankings, because from the top you can only come down, from the bottom you can go only up, right?
वो कहते हैं ना कि कोई आदमी जमीन पे गिर गया तो उसे बहुत तकलीफ हुई और उसने अपने गुरु से पूछा कि मैं इतना नीचे गिर गया, अभी क्या करूं? बोला, अच्छी बात है ना, इससे नीचे नहीं गिर सकते, अब ऊपर ही उठना है.
Absolutely right. So I think, according to me, the easiest way to sell is go to their clients, sir, look at this return, easy check, easy sale done. But eventually one should not forget that you are the one who have to answer for that fund and that fund's performance after 2 or 3 years when it doesn't do well, right? And there is where the whole acidity comes, right? Then the blame game that the fund is bad, the fund manager is bad, the fund did not do this, did not do that, all these things come. So there is no right or wrong answer in this, but yes, I think I'll draw a parallel to you and me trying to do the same thing in stocks directly. Now, when we are trying to do the same thing, we are trying to buy stocks for ourselves. Let's say we want to buy 10 stocks which can give good returns in the future. Markets are about future. We all know this. Investing into stocks, if I have to directly, I have to see into the future. Right now, if I tell you X company has done 100% in the last 1 year, and I will tell you that, okay, you buy this stock, the natural answer will be that ye to chal chuka hai. Agla batao. Right? So you are naturally asking me this question that this is worked already. This is looking like it is done very well in the past. But tell me something about the future. Right? Now, when we are looking at stocks, we are trying to look into future. We are not trying to look into the past. We want to avoid the past winners. We want to look at the future winners. And therefore, we try to get into the ideation part, which is where we try to, again, coming back to what we popularly practice also, QGLP. So we try to understand businesses. We try to understand which themes will do well, within the themes, which sectors will do well, within the sectors, which companies will do well. Are the companies demonstrating very good growth potential in terms of the earnings growth trajectory, and is this quality and growth available to you at good P multiples or price to book or price to sales, whatever valuation or price earning to growth, whichever ratio you feel comfortable, you can apply those ratios. Typically it will draw the parallels, right? You do this exercise, you buy, and then what are we doing? We are waiting. Sometimes you're lucky, you may make money in the first year. You're not lucky, You might have to wait for 3 years, 5 years, 7 years, 10 years. You spoke about Reliance Industries, 2007 to 2018. That's a good 8, 9, 10, 11 years. The stock was doing 7% IRR. And those loyal shareholders who did not sell the stock for those 13-year period with a 7% IRR made a 3.5 times in 3 years, 18, 19, 20, 21, and 22. Now it's settled at, so 700 rupees going up to 2,500. Now, what is the return of the past 10 years? Very, very different, right? Same thing applies in mutual funds, right? You do your research, you understand the fund manager, philosophy, track record, past, you do all your analysis. When you get your full conviction, you buy the fund at the bottom of the cycle. Like most foreign institution investors whom we talk to, and we talk to foreign institution investors very, very regularly, their philosophy is that spend a lot of time with the manager trying to understand the mindset of the fund manager, and when he performs, when he doesn't perform. And once they freeze on to 3 or 4 managers where they want to put their money, they wait for those managers to do bad. And when they do bad, they come with big bucks. Actually, and when the cycle goes up, whatever time it takes, they move out also.
Actually, probably no one ever did this analysis, but mujhe lagta hai ki it may not work in stocks, but it may work in a basket of funds, that if you buy the worst performing funds for a medium to long duration time, it can actually deliver very good return, because one stock can continuously go down, but a basket of good portfolio stock may not continuously go down. At some point of time, when the cycle reverses, it can go up. And yes, before I ask you the next question, one of the top fund managers I remember many years ago in a conference said this: when I buy a stock, I don't know when it will go up. I know it will go up, but sometime my stock doesn't move for 4 years, and in the 5th year, it doubles.
Yeah.
The second stock, it goes up by 20% every year, and it also doubles in 5 years' time. So the ultimate result of both the stock which I buy may have doubled in 5 years, but it has different experience for different investors who came in at different times.
Absolutely.
With this pretext, I want to ask you, will you like to add to this in terms of the theme of this program today, how this performance cycle works in mutual funds?
See, mutual funds are basically basket of 25, 30 companies. I mean, typically we practice concentrated and focused investing. So we take 30, 35 stocks, right? Now, why do we take 35 stocks? Obviously is because we know that all stocks will not go up at all together at one point of time. So at some points of time, there'll be at any point of time, 1/3 of the companies would be doing very well and 2/3 of the company would be flat to negative. And what you enjoy is the average of good and bad, right? Typically in an index also, and I'm seeing some pop-ups coming on index funds. What is index? Index is also like a portfolio. Index also has good companies and not so good companies. The average return, what you make in index, is the outcome of few companies doing well and few companies not doing well, and therefore you make a 15% average return, right? So now when a mutual fund manager is not performing, let's say, right, we are trying to analyze the companies which have not done well. For whatever reasons it has not done well. But in the index, when those 2/3 companies are not doing well, we are not asking question to the index manager that why have you not bought all the winners? Even index is facing the same situation. Even index goes down, index also goes up. Sometimes the active managers are over the index. Sometimes the active managers are under the index, right? So see, eventually in markets, in portfolios, in stocks, basically over a long term, we are enjoying average of good and bad times, right? So, and that is where we say that, when you come into markets, you have to come for long term, because you don't know which years are going to be the good years, which years are going to be the bad years when you live through the good and the bad years. And typically, let me tell you, there are more number of bad years than good years.
Correct.
In the last cycle from 2014, after Modi coming in, we have seen the stock markets getting very, very active. If you see 2014 to 2022, only 3 years have given you returns. And if you are absent in those 3 years, your return is nothing. So 2014, 2017, and 2021 were the 3 years where markets gave phenomenal returns, like 70, 80, 100% kinds. And rest of the years have been negative, flattish. Right? Those who bought into equities in March, April, May of 2020 are laughing away to the bank. Those who bought in 2021 are now wondering what happened. Today, those who are buying are going to make, I can tell you, today, whoever is buying, and fortunately, a lot of people are buying, are going to make a lot of money next year.
Possibly, yes.
But But today, those who have bought last year and are giving up and probably exiting, and we are seeing redemptions also, they are the ones who are going to suffer. They are the ones who will not make returns. Index also, I can give so many examples actually on this, because as I said that we've done a lot of work on this. Index, BSE Sensex 30 companies, 40-year history, average return 15%. Any 7-year rolling return period, once you cross that 7th-year period, your chance of losing money. So first of all, what is risk? The risk of losing your capital, it goes away in the 7th year. You don't lose money. Yet the worst investor makes 4% return, best investor makes 28% return. So an investor may be curious that 7 years, I took risk, I gave time, and still I made 4%. That is, if you're buying only on tops, then you make 4%. If you're buying bottoms and tops, then you make 28%. So there can be a lot of ways we can analyze what we learn. What we say is that history may not repeat, but history may rhyme. Right? So we need to go back into history and see a lot of cuts to understand how performances, and I'll try to come in Hindi, Manish, I note your point. Now I'll give you one last, and we'll stick to this performance cycle. I know you told me 2-3 minutes each answer, but as it comes to my mind, I'll keep answering. I was seeing this data, which I've been using in seminars very often. So we tried to look at the India's most longevated bull market, which was 2002 to 2008. 2002 Nifty was 1,000 points. 2008 Nifty was 6,000. Those who invested in 2002 stayed invested till 2008, made us clean six bagger, 6 times. You know what, Brijesh, if you see that chart closely, and I'm using it, but I just realized a couple of days back that those who invested in 2002 actually never made any money in 3, 4, 5. Now just imagine 3, 4, 5, no money. And in between there were 3 corrections. And one correction was 30% when the UPA NDA changed to UPA. So there was a 30% correction. 2002 and 2004, 3 year is a time horizon we give to markets and funds. We exited. 80% of the return came in 2006, 7, 8. The chart goes like this. So it is like this and like this. So okay, that is sitting tight. Coming back, that is the sitting tight one.
Correct. So again, a message and an observation to mutual fund distributors, RIAs, and others that the purpose of having this talk is two-way. And I know many of you have investments in Motilal, and we will have a specific question to Akhil to answer questions on Motilal Focused, Flexi, 30, whatever. We will have those questions with Akhil. We will have you get the answers to your questions. But there are 2 objectives to this: that how does the performance cycle works in the market, and then the questions related to Motilal funds. So I will ask you again, Akhil, if I invest in a mutual fund scheme.
Brijesh, 1 second. I'm very sorry. I'm really very sorry. I do want to show one chart, because that chart I made for the previous question. And generally when I start to talk, I just keep on talking. Can you give me the right to?
You should already have. You don't have rights?
No, I don't have the right.
Just wait. I will give you.
This is what I want to demonstrate by showing you that every time you buy the best performing funds of last 3 years, what is the outcome in the next 3 years? Answer is right there.
You can share.
Yeah, I'm good. Okay, so this is the slide which I've made for the audience here. This is the chart which we have. It comes from our own private wealth management company. We keep refreshing this data every month. Now we have prepared this chart since 2009. So it's a good 13, 14 years. Now what you see is that if you would have bought, and willy-nilly we would have done that, best performing or the number 1 fund between 2009 and 11, in hindsight, then this number 1 fund actually between 2012 and 14 became 162nd. If you would have bought the number 1 fund of 2010 to 12, then this fund became 123rd rank. And this is not by market cap buckets. This is all the mutual funds listed, all large cap, mid cap, small cap. We can break this in buckets. The result will be very similar. Recent example, 2016 to 18, probably here Motilal Oswal Flexi Cap Fund would have been the top fund, which has come down to 77th ranking. Right now you have bought this number 1 fund because at that point of time, you would have liked the fund manager, you would have liked the asset management company, you would have liked the returns, you would have liked the portfolio, you would have liked the way the fund manager talks, you would have liked everything about this company because it is doing good. Now in 3 years, suddenly what happens when the rankings go down, that same things what we liked is now no longer likable. Are you getting my point?
Excellent. This chart is excellent.
Now, what you have to do here, honestly, if I have to do as an investor, and I've started to do this, although I still continue to be an MO, but what I would do if I was a mutual fund distributor is I would then first shortlist 15, 20 schemes, whatever fund houses, whatever I like. And I will, rather than descending order, go ascending order. Ascending order returns filter down of the favorite fund houses you like. And then this fund, which basically is becoming 172nd or 123rd, someplace you have to get in here to experience that recovery, that Q4 when it goes to Q3, Q2, Q1, is that money making what you experience. As I said, Q1 will only come down to Q2 and Q3, but Q3 will only go up to Q2, Q1, as long as the fund manager and the fund house and the philosophy and the stock picking, everything remains great and good. That homework you have to do, right? Look at this, even the market cap cycles, if you see Nifty 50, Nifty 500, Nifty mid cap, all of them they are also behaving very, very differently. If you buy Nifty 50, let's say between 2012 and 2014, 21%, next 3 year Nifty 50 also gives you 8% return. I'm telling you that last 5 years, small cap index has given negative return today. 2017, 9,500 was small cap 100 index. Today it is 8,500. It is a screeching bet that this is the time to get more allocation into small caps. Mid caps are flat and large caps have outperformed mid cap and small cap. That is how you do. So even markets are behaving the similar way, the way funds behave. Right? I'll give you one more example here. This is also a slide. I don't know if a lot of people have seen this. This is also classic investors, distributors trying to time the best versus, what. So we took the best index fund of last 3 years, which was ARC, and, some phenomenal returns. And we compared that stock with that fund or ETF with the return of Berkshire Hathaway. Now, Berkshire, so this is Feb 20 to December 21, just for illustrative purposes. Actually, it happened. Now, here we would have seen that the ARC fund between Feb 20 and December 20, 100 rupee became 264, 2.6 times. And we would have been lapping up into this fund because this fund is giving great returns. And we were cribbing about Berkshire Hathaway, who basically remained same, 100 to 103 flat in those 6-month period. Next 6 months, what happens is 264 gets corrected down to 136. And this 103 goes up to 140. Now, who's the winner and who's the loser? Let's say you were a shareholder of Berkshire and you were a shareholder of ARC. ARC was doing better than Berkshire, so you ended up buying more of ARC and you decided to get out of Berkshire and get more into ARC. But after 1 year of period, one full 1.5 year of period, what you realize is you have not done any intelligent thing by selling out one and buying out the other, because both are at same level. I'm tracking my own funds, at least my PMS portfolios. I track it more because we have a lot of investor conversations. The best performing 3 funds, 3 PMS managers of last 3 years, and which also has been rotating. My flagship portfolio, the difference, which was 8-10%, we were below them, the best performing, average of the best performing, versus my multi-cap portfolio. Today, the gap has come down to same. I mean, 2-year return of my anti-dop portfolio is 30%. The other one is 20, 32, 31. So, but a lot of money moved from anti-dop into those portfolios. But the experience is same. तो इसमें क्या कौन अमिताभ बच्चन बन गया कि आपने अरे यार वो उस टाइम पे खराब कर रहा था तो उसको बेचा, ये ले लिया, बट एंड में रिजल्ट वही आ रहा है, right? So spend a lot of time with the managers you are backing up. When they're not doing well, understand why they're not doing well and why will they do well. If you understand that broadly the strategy seems good, we need to wait out for whatever time it takes. Believe me, you will get more than compensated for the time you give to that portfolio, which is for some point of time not performing.
So
you look at this. Sorry, just I'm very sorry, Brajesh, but we need to show this for investors because I made this only for you. You see this buying euphoria, selling in panic. Jan 8, this was euphoria, selling in panic. You make 1.5% return. This is buying the top, selling the bottoms. You buy in Jan 2008, sell in October. So buying in euphoria, selling in euphoria, still you make 8%. Top to top. Top to bottom, top to top. October 2008. From there, the market started to move up and you sell in panic again in March 20. you make 9.7. So you're making fixed income returns. This is the return of average investor, I'm telling you.
Still not bad, yeah.
Now you buy bottom and you sell in euphoria. Then you make 16%, which is buy low and sell high.
Fantastic.
So, which is why we say that when funds are not doing well, that is not the time to sell. Now you have entered, you stay there.
So Akhil, Shreya has put up a very nice question, and I will add my observation. If you can stop the sharing. So to get away from the confusion of the mutual fund distributor, I want to simplify this question to you. खराब फंड खरीदना चाहिए या अच्छा फंड खरीदना चाहिए, पहला क्वेश्चन. और उसको कितने दिन तक होल्ड करना चाहिए, कितना साल का पैनिक, कितना साल का पेशेंस रखना चाहिए, और कभी उसको बेचना चाहिए या नहीं, और बेचना चाहिए तो कब बेचना चाहिए?
देखिए, इसका सीधा कोई आंसर नहीं है ऑनेस्टली. आप खरीदने के पहले साल लगाइए, 2 साल लगाइए, 3 साल लगाइए अपने आप को कन्विंस करने के लिए कि मुझे कौन से फंड में बेट करना है. पहली बात तो वो है, आप कन्विंस होइए. आप रिटर्न के बेसिस पे कन्विंस मत होइए, आप फंडामेंटल के बेसिस पे कंफर्म होइए. जैसे ही आप कन्विंस होते हैं, फिर चाहे 3 साल लगे, 5 साल लगे, बट मेरे हिसाब से 10 साल का पीरियड होना चाहिए. कोई भी आप घुसे हो तो जब तक फंड अच्छा है, मतलब दैट इज अ डिस्क्लेमर आई एम पुटिंग अगेन एंड अगेन. As long as we are managers are sticking to their philosophy, then 10 year is a good cycle where you will see 2-3 ups downs, and in between good managers will certainly perform, and you will get decent average return hopefully over the markets also. But 10 year is a good cycle. 5 years, 6 years, 7 year, I don't believe in it.
In a way, you are saying on a lighter note, if you are looking for a partner for marriage, do the due diligence for 1 to 3 years.
Yes.
Stick around for 20, 30 years, and the good times and the bad times. The same philosophy applies with a fund manager, fund house.
Yes, absolutely. See, I am an investor of Flexi Cap day one. My own F35 fund, F35 Flexi is same thing. I bought in the NFO in 2014, 10 rupee. First 4 years, I got 33% compounding. Last 4 years, I got 8% compounding. My average return is 16%. My outperformance since inception is 1.2%.
But अभी क्या है ना,
8 साल हो गए हैं
अखिल. हाँ. इंडियन कॉन्टेक्स्ट के अंदर में शादी से निकलना इतना आसान नहीं होता. फंड हाउस से निकलना आसान होता है, और फंड हाउस को होल्ड करना बहुत मुश्किल होता है कि अगर वो परफॉर्म नहीं कर रहा है और आपके सामने बहुत सारे दूसरे ऑप्शंस हैं. Then you tend to change the scheme, then you tend to change the lane. So I want to come specific to this question now, and I think a lot of people, 325, 50 people are waiting for this question. How long should one wait in Motilal Flexi Cap Fund?
Now that you have, and for those who have kept the patience and those who have, been loyal to the fund and the fund house and the fund itself, the fund manager, I think we are very close. We are very close. I am seeing all the right. In fact, if you allow, I can show 2 or 3 slides where we are exactly similar to where we started off in 2014. I'll tell you what happened in Flexi Cap Fund. Okay, so now since we keep talking about Flexi Cap Fund, let's look at that.
And audience, if you have any question, please write to me in the Q&A chat box. I may not take all your questions, but I will try to pick up some interesting ones and scratch the mind of Akhil Chaturvedi.
Now, Flexi Cap Fund, I'm not talking about any story. I'm not selling the fund. I'm just trying to show the fundamentals, just the numbers part. This is a typical, 1 year rolling return of the fund. So there have been times where we've done very well, and there are more years actually out of 7 1 year rolling returns. There are 4 1 years where we've outperformed and 3 where we have underperformed. But what is more important is what I was trying to explain is that 10 rupee NAV went up to almost 22% compounding till 2018, then 7% NAV. Now here is where this fund for last 3-4 years has been struggling. And for all the right reasons, I feel that there is a strong case for the mean reversion to happen. Somewhere we have bottomed out. Somewhere we will bounce back. How we will bounce back, we'll try to understand that. We have been keeping our bets through the tough times, and now we are sitting tight on this for the last 3 years and waiting for these companies to do well. Banks were underperforming Nifty 500 for last 3 years. Right, Brijesh?
Yes.
Autos have been underperforming Nifty 500 for the last 3 years. Autos have gone through a very tough cycle. Banks have gone through, after IBC, through a very tough cycle. Insurance companies, because of the COVID, unfortunately went through a tough cycle. So barring the IT part, now here is where we took our active bets, right? So we are overweight as compared to the markets, right? And this is what gave us pain. Now, these names are all the blue chip names. I mean, HDFC Bank profitability never came down. But the stock has not outperformed Nifty 500. ICICI Bank has become stronger than HDFC Bank. In fact, ICICI Bank now is more expensive than HDFC Bank. But the stock has been underperforming the benchmark on a 3-year basis. State Bank of India has come out beautifully. They make 10,000 crores of profit every quarter. But the stock is still available at 1-time price to book. The top for SBI is 2-time price to book. AU is one bank which has done well. HDFC Insurance, ICICI Lombard, best insurance company, underperforming. Maruti, now you see, now what? Now the headwinds are turning into tailwinds for the banks, for the insurance companies, for the auto companies, and IT after this correction seems that TCS result has come out. It is looking good. It is given a beat, right? So what became the source of underperformance will itself become the source of outperformance. And this is where we practiced our sitting tight philosophy. We did not get conviction from metals, so we did not move or change lanes into metal last year. And the metal stocks are down 50%. Had we changed lanes, I would have sold this at bottom and bought that on top and then again suffered. So we are paying price of holding to good companies in their bad times, waiting for markets to give valuations to these companies now. So I feel that this portfolio is rotating, which we can already see in the recent performance. If you see, we are already started to move up on 1 quarter, but it's too early, so I don't want to make any tall claims. Again, on numbers, if you see this, in 2018, when we started to slip down, what was the reason of slipping down? Basically, our earnings growth came down to 3%. There was no growth because these were mostly consumer stocks, financial stocks, where the profits had come down. No earnings growth, no price movement, and we paid a price for that. The learning was that maybe we have to give up on some of our winners and not hold on to them for way too long. So that is my learning, trimming the winners at regular intervals, right? So this is what happened in 2018, why we suffered. This same 3% earnings growth was basically 18% when we started the fund. 18% growth at 22p multiple made the fund 33% compounder, the best performing product. Today, if you see the valuation, it is exactly same what it was in 18% earnings growth. You see the EPS growth 22% for the next 3 years today, next 2 years. So my portfolio, if this is one company, will grow its profits at 22%, available at 18-time P multiple. Nothing to lose, a lot to gain, which is where I feel that we are bottomed out. And from here,
Akhil, Flexi Cap mein mera ye last question hai on behalf of the audience, and I will move on to some other questions. Please bear with me. My question is, 2018 में Flexi Cap was the best performer. उम्मीद तो बहुत लगती है कि आगे बहुत अच्छा जाएगा, बट 2019 में अच्छा नहीं हुआ, 20 में अच्छा नहीं हुआ, 21 में अच्छा नहीं हुआ, और यही स्टोरी सोच करके कि आगे अच्छा होगा, हम अभी तक उसको होल्ड कर रहे हैं. अगले 2 साल भी अगर ये साइकिल वापस से इंप्रूव नहीं हुई, तो इन्वेस्टर क्या करेगा और म्यूचुअल फंड को क्या करना चाहिए, डिस्ट्रीब्यूटर?
There are 2 ways to answer. One is you fire the manager and you switch out. That is the easiest way.
क्वेश्चन और भी आया है कि शायद आप लोग फायर कर रहे हैं या इनहेरेंट चेंजेस है. Somebody is asking, so many fund managers have been changed in Flexi Cap fund of Motilal. What is the
very good question. We'll address all of that. बहुत सारे myth. विजय जी, इसमें ना आपने जो क्वेश्चन पूछा, इसमें myth बहुत है. मिथ ये है कि हम 4 साल तक नहीं
कर रहे हैं ताकि आप अपने मिथ को क्लियर कर पाए.
आप हमारे रिटर्न्स को FY18 फाइनेंशियल ईयर में अगर ब्रेक करके देखेंगे, तो FY18 में हमने अंडर परफॉर्म किया था. 19 में प्री कोविड हम लोग आउट परफॉर्म कर रहे थे मार्केट को. 2000 ये जो पोस्ट कोविड रिकवरी रैली हुआ, जिसमें स्पेशलिटी केमिकल और मेटल और रिलायंस इंडस्ट्री जो चला, ये 3 चीजों में हमारा 0 एक्सपोजर था. उसके कारण पिछले 1 साल का परफॉर्मेंस जो था, उसमें बहुत बड़ा गैप आ गया. बहुत बड़ा मतलब वी ग्रू ओनली 4%, इंडेक्स वेंट अप 20%, 16% का अंडर परफॉर्मेंस जो था, इट एट इनटू माय 2 year, 3 year, 5 year रिटर्न. My one bad year has killed my 5 years. What if I have one good year? My 5 years will look very different. Same thing, Reliance Industry, what I spoke about. Right? So just that, yeah.
So again, the question, not related to Flexi Cap, but the question which I will ask you is that, is it in the hands of a mutual fund manager to change performance of the scheme in the future? If yes, first of all, why did it happen in the past that you could not identify the winners? And if you could not identify, when I say you, doesn't mean you or FlexiCap or Akhil or fund manager, the mutual fund industry as a whole. If any mutual fund scheme is going down and the fund manager could not protect it, it gives the impression that कि जब ऊपर भी जा रहा है तो बस जा रहा है. It is not in the hands of the mutual fund for manager to pick the right stock in the future, because as you rightly said, last 1 year, the 3-4 stocks where you were not there killed the performance of last 4-5 years CAGR.
Yeah.
So how do you, as a distributor investor, pick up those fund managers? Because उनके हाथ में भी ऐसा लगता है कि उनके हाथ में भी नहीं है, सब भगवान चला रहे हैं, ऊपर वाला चला रहा है, बस इंडस्ट्री चल रही है. What is your opinion?
It's not like that. We have amazing talent in our industry. We have amazing fund managers. We have amazing fund managers with very good philosophy. The way they pick their stocks, this is their own mindset, their own conviction, their own thought process, and every human being has their own thought process, right? So that's where the beauty of diversification comes, that you can buy 3-4 styles through different managers, diversify, and at any point of time 2-3 will be doing good, 2-3 don't do well, you'll get your average return. Correct. Right? So managers to some extent obviously have a very large role to play in recovering performances. To some extent, yes, but to a large extent they also have to depend on the market cycles. Right. So yes, I mean, let's say a fund is not doing well, and then, let's say you bring in a good manager, or there is a good manager, he makes certain changes, tries to do some changes, which we are also trying to do. We have done that in one of our fund, mid-cap fund. The guy changed his selection, his allocation, did a couple of things, and he revived the fund. Right. But market supported him. Market supported him in a way that when the mid-cap fund was coming up, while he did his good selection and allocation, mid-cap as a index also was going up, right? So market cycle was also doing well, and stock picking was good, and possibly he has bought at decent valuation, which is where he made a lot of money. So it is a combination of fund manager skill and what the market is doing, right? Now, value managers will have their, in a decade, they will have 3-4 years good. Growth managers will have their own 3 or 4 years good. Different managers will have. That's why I said you need a 10-year cycle to experience those 3 or 4 good years. 5-6 साल तो खराब ही होने वाले हैं. 3 साल में पैसा बनता है. वो 3 साल उस मैनेजर के स्टाइल में आप आ जाओगे तो आपका 15, 16, 17% बन जाता है.
Right. So one question on Motilal 30 and Motilal FlexiCap. Motilal 30 is an outperformer in the last 12 months. 2 out of 27 funds, top ranked. Motilal Flexi is an underperformer in the last 1 year. If you were a mutual fund distributor, with the discussion that we had in the last half an hour, 45 minutes, that the cycle reverses, the mean reversion happens, and you have to stay for long term. If you have to buy a new fund, you should buy Motilal 30 because it is extremely good performing in the last 1 year, or you should buy Motilal Flex. I'm taking those 2 names because these are the 2 most common names. They are dynamic, they are focused, but we don't have enough time to discuss specifically on specific funds. And so please excuse me. So should I buy Motilal 30 on the basis of last 1 year performance, which is very good, or Motilal FlexiCap on the basis that last 1 year performance is not very good, and in the future it should mean reverse and you should do well?
So you're putting me into a trap because both are my funds, and you are telling me to give a buy call on one and a sell call on the other one.
You can diplomatically stay away because I will not push you. Because
no, I'll give you a straight answer. I'm not a diplomatic person. I'm a very straight person. Now, our mid-cap fund, Brijesh, that go back in 2020, March 2020 or April 2020, this same mid-cap fund was 23 on 23. What you are telling about my FlexiCap fund. We were the last in the last. We suffered heavily in the COVID correction because of a higher exposure to financials. So March 20 to March 21, we were the worst performing fund, our own mid-cap fund. We knew the changes are happening, the stocks are changing, the cycle is changing, economy is moving up. We knew that this fund will move up, and we were saying that bet on mid-cap 30. We were making case for mid-cap 30 to the distributors through our roadshows and seminars. And then April 21 to March 22, we are the quartile one, not quartile one, number one. And number one, not only for 1 year, 1 year, 2 year, 3 year, 5 years, 7 years since inception. One good year has changed my entire spectrum of 7 years. अब उसी में पैसा आ रहा है.
उसी में पैसा.
But as Akhil, my SIPs are doubling in Flexi Cap Fund.
Oh, so the answer is very clear for the audience, And my objective here is to be a moderator. So I'm not in for and against any particular scheme. I want to get the best out of the fund manager, the company, in terms of giving answers to questions of mutual fund distributor. So this question was very pertinent. कि मोतीलाल 30 ले कि फ्लेक्सी कैप ले होल्ड करे कि बेचे और कब तक वेट करे इसको हमको आज एनालाइज करना था फ्रॉम द पर्सपेक्टिव ऑफ मोतीलाल इन द मार्केट साइकिल सो दिस इज वन पार्ट
सो मिड कैप 30 का प्राइस अर्निंग टू ग्रोथ, how much multiple you pay to how much growth, was about 1.2 times, which is very close to 1, means very cheap 1 year back. It is, because it has done well, it has gone up to 2. Somewhere over 2.5, one has to be cautious and maybe taking profits off if you have invested at the right time. Certainly not a good time to get on there at that level. Flexi Cap Fund today is 1.2. Don't come at 2, come at 1.2.
So Dipta Sen Gupta is making a very interesting point. On a different note, this might be good news for SIP investors of Motilal Oswal Flexi Cap Fund. Should I infer that they were buying a good fund units every month cheap? This might change SIP returns.
Amazing. Beautiful. Absolutely. Perfect. For the last 2-3 years, I have been buying Flexi Cap units in the range of 28 and 32 rupee NAV. So whenever and someday the NAV will go to 60, 70, 80, but I have bulk of my units in that range of 20, 32. So who will be laughing away to bank after 3 years, and who will be wondering, scratching head will be, the jury will be there at that point of time. But yes, I think the analogy is right. In fact, I was having a conversation with one of the, she's my, I respect her a lot, Rupa Venkat, and she is really backing us. One mutual fund distributor who's really given a lot of allocation to Flexi Cap and holding on through this tough time. And she's saying the same thing that I'm telling my investors, that you are buying more units of this fund, which has good potential. And whenever this does well, the compounding rate will be very different of these investors versus those who will come on those days, on the top days. So I completely endorse ma'am's view.
I did some few brief answers from you on some of the question. Again, Shreya is asking, while researching on a fund, should we highly rank fund manager psychology, his track record, objective of the fund, rather than other parameters?
Everything you have to analyze. Most of it, you need to ask the right questions to the manager, and the most simple questions you need to ask, apart from doing your study on the manager, because every data is available on all the websites of Master Stroke and Value Research. All data is available of fund manager thought process, mindset, when they do well, when they don't do well. This sabko sab pata hai. But I think when you are interacting with the fund managers, try and analyze how they are looking at things going forward. Where is their conviction? And that conviction, is it reflecting in the fund through the selection and the allocation? And then most of it, which people don't share, is asking some of the fundamental question, is that if I'm giving you money today, what is the growth of your portfolio I'm expecting in the next 3 years? And what is the P multiple I'm giving to your portfolio? These 2-3 questions just ask. Most of the managers will not give you straight answer at that point of time immediately. But if you have to buy low and sell high, then getting that answer of growth and P multiple is very, very important. Like I'm telling you that Flexi Cap Fund is available. You're getting a 22% growth at 18 times P multiple, which means you are at below 1 time price earning to growth. Nothing to lose from here. We are not falling as much. At the same time, we are not growing. So like I said, from here, we will only grow. At least we are not falling.
Okay. So Motilal, in some of the discussions, is quite vocal that there's a lot of promoters' money invested in Motilal funds. Is this data, and I will excuse you if you don't want to answer this because of compliance or other reason, is this data publicly available? Or would you like to make any observation that which are the funds where most of the funds are invested of the promoters in the Motilal funds? Or if you want to answer this question in a way that, we will not go through the PMS because this program is not on the PMS and there are certain questions around PMS, we will excuse those questions. So any answer on this promoter stake in Motilal?
Yeah, so I'll take 2 minutes. Our promoters, when they decided to build this business and get a lot of public money, they decided that they will not have 2 different portfolios. So they sold off their entire stock portfolio. Ramdev Agarwal has built his wealth through stocks. 2014, when Flexi Cap Fund was launched, actually the fund was launched for us. So we sold off our stock portfolio, our matlab Ramdev ji, Motilal ji, all their families, trust, everything. They sold off all their direct DP and they put all money. Since then, the money is only coming into our own mutual fund schemes. It started off with a small number, 250, 300 crores. Today it has become 4,200 crores. Out of the 4,200 crores, about 2,000 crores is their personal money. The rest of it is corporate balance sheet, which is publicly available. You can have a look at that. Out of this 4,200, which is prop money, what we call as prop money, promoters and our institution, we have about 2,200 crores, which is 20% of the AUM of Flexi Cap Fund, are prop. So on 10,000 crores, 2,200 crores is our own money, and we are going through the same result which most of the investors are going through in the last couple of years. And we have not put this money to just lie flat. We have put this money to grow, right? So we have our own targets in mind, and therefore, I will win only if you will win. I can only tell you that much. We have 1,100 crores out of 2,700 crores in our mid-cap fund. So I am a 40% owner of my mid-cap fund. I have 300 crores over 1,100 crores in my large and mid-cap fund. I have 125 crores over 1,100 crores in my Focus 25 fund. All put together, we have 4,200 crores. Every year, as the profits come out and after paying out the dividends, the rest of the cash flows are redeployed into the schemes in same fashion.
This is brilliant, Akhil. And we will have just one or two questions and then we will close this. Would you like to make an observation on index investing and active management funds? And what is the, so at Motilal, index investing is a theme, or you aggressively promote active funds or passive funds? So because as a fund house, you have to have all the products, we understand that. So yes, what is the internal thought process?
As investors, we believe that India is an alpha market, and therefore active managers will do better than the index. And therefore, we feel that, at least our prop money goes in active, it doesn't go in passive. Okay, because we feel we are an alpha market. We have not become US. Our markets are still inefficient. US markets are very efficient. So therefore, there is that gap which gives you opportunity to spot ideas or companies which can give you better growth than the index companies' growth. There will be some points of time like last year or 2 years where active managers are underperforming and bulk of the active managers are underperforming. So, you need to excuse that. But broadly, I feel that active managers will do better than the index. It's an alpha market. So that's point number one. As a business house, we are creating a basket of passive funds, both international and domestic, for certain set of clients who maybe are new, who maybe are just starting, or some institution investors or some family offices who want to sometime a mid cap or a small cap. So we are creating solutions for certain set of investors. And but we are not leaving the equity plank. So within equity, we have active and we have passive. Passive is more of a solution business and giving solutions to investors, and just trying to build a case, because eventually someday even passive will become big. International funds, passives have become very large. We are the largest. We have 10,000 crores in NASDAQ and S&P 500. Domestic is still very, very small. Very small. But literally Pratik and his team has to do a lot of hard work to get money in domestic passive, because we all out here, investors, distributors, and AMCs, feel that active managers will do better than passive managers. There is where in domestically we are getting more money in active. Internationally, more money is coming in passive. Right. So, but maybe 10 years, 15 years. See, when we launched NASDAQ 100 fund in 2010, nobody bought into it. It was a 75 crore AUM fund till 3 years back, and it became 8,000 crore fund in the last 2 years, right? But we had to launch 10 years back, right? This is what the vision is, right? So that is a separate asset class, and one is free. If you can't figure out, I can tell you personally also, sometimes when I allocate and, when markets get very volatile, just very recently, 2 months back, when small caps were correcting heavily, I was not understanding. I wanted to allocate money to small cap, but I couldn't figure out which active manager to give. So for a moment, I just put money in Motilal Oswal small cap 250. At least I'm buying the market. At least I will get the market return. So there are points of time when these ideas are very good, right? So be open towards this. I don't know why we have this discussions around active and passives. I mean, these are all product lines. Different investors have different needs. as advisors, distributors, salespeople, eventually we are salespeople. We need to have everything in our sales folder and we need to meet the needs of the clients. So, I mean, there are, Brijesh, right? Questions come that, you are active, then why are you launching passive? And your passive manager is not putting money in passive. So, I mean, I think these are questions which are not relevant, absolutely not relevant, right? So, I think I will rest my case by just saying that as a group, our commitment of 4,000 crores, which will become 40,000 crores in the next 10 years, I can tell you that. Sure. Right? So 4,000 crores is all in active, zero money is in passive. It is only solutions for certain set of investors, and there are certain set of investors who are investing.
Fantastic. I think that's it, Akhil. I think our members and distributors got very good answers. I will leave the decision to them to stay into Motilal, to increase the exposure or to exit. That the decision rests to them. The objective was to give a view from the horse's mouth what the fund house thinks about performance cycle and about some of its own funds. And you beautifully explained some of the concepts as well as the skin in the game of the promoter in the funds. So yes. Any final observations on Masterstroke, on Motilal or the markets, anything?
Certainly. I will just want to conclude by saying that this call I accepted from Brijesh, not to make a case for Motilal Oswal AMC as a salesman. I made this case to give some clarity to the partners who supported us in the tough times, have been supporting us in the tough times, to figure out what we are trying to do. Clearly, in the last 3 years, if I have to sum up, our 3 learnings which we are trying to work on is where we went wrong is trimming the winners, cutting the laggards, and being mindful of exclusions. These are the 3 broad learnings we saw that we probably could have done a better job. And perhaps my returns would have been more consistent than what it was, which we have now put into practice. So at regular intervals, in the interest of time, I've not gone into those slides. If you see midcap 30 as example, the churn ratios have gone up. We are taking up profits regularly. We keep identifying new ideas. So we keep replacing. So we keep doing those shuffling of ideas. So we are protecting the IRR. We have also started to buy 1 or 2 stocks as a principle of exclusion mindfulness. Whether we have full conviction on that company or not, that's a different subject. But because these companies, simply you can't miss it. I'm not naming those companies, but you just need to have. So we are having some exposure to those companies as a exclusion mindfulness. And in laggards, we have cleaned off a lot of stocks which are simply they don't do anything in the portfolio. So first introspect, identify the gaps, plug the gaps, then execute. So strategy, then execution. I feel we are doing a lot of hard work. We understand that if you're in this business, you have to perform. We will perform. We are doing all the hard work to perform. Give us time, give us your patience. And yes, if at all you like Motilal Oswal AMC, you like Ramdev Agarwal, you like UGLP philosophy, then this is the time to bet us on, because today we are at the bottom. From here, we will only go up. How much up, I don't know. When, I don't know. But from here, nothing to lose much. So thank you again, Brijesh, for this opportunity. It was an amazing talk. And sorry, I was breaching the 2-3 minute.
No, that's perfectly fine. I think this went
that is me.
Well. And the best thing I liked about this talk today was very candid, very honest, and the learnings that Motilal has, and you will use those to enhance returns for the investors. And I want to tell the audience one thing. When we were preparing for this interview, I asked Akhil, do you have any reservations to any questions which I may ask? And he said, no, you can ask me any impromptu question on anything. And we did exactly that. So that's how Akhil is, and he did not shy away from any of the questions. And this is the background I wanted to tell all the audience that, there were no questions with Akhil, said that, you may not ask. And he also answered the promoters, and I really like the way you answered, Akhil. Thank you so much, and I wish you all the best, Motilal AMC, all the very, very best.
We need it.
Reverse in most of your schemes, and we stay hopeful. And with that, I will say thank you so much for coming over and explaining your thoughts with this.
No, we need your good wishes, all of your good wishes, best wishes. Sure. Give us all the positive energies, and we'll do a good job. Thank you so much once again, everyone. Thank you so much for coming Saturday evening. Look forward to some more sessions in future. Thank you so much.
Thank you so much. Thank you so much. We'll stop the recording now.
Yeah.